Gold hitting new highs today, north of $3,750 an ounce. Part of the story, the expectation of more rate cuts and lower rates seen as good for gold. We also get that crucial U.S. inflation gauge, the Personal Consumption Expenditure Index, on Friday. We're joined by Daniel Ghali, Director of Commodity Strategy at TD Securities. Daniel, always great to see you, and thank you very much indeed. What's your thesis on gold?
Andy.
Do you see yet more upside?
Yeah, well, look, Andy, this is what it looks like when the U.S. dollar is at least partially losing its store of value function. I mean, what kind of a market context is there when the stock market is at an all-time high? The bond market has, at the very least, ended a bear market and perhaps resumed a new bull market. Credit markets are at their tights. Commodity prices are rallying. What kind of a market context causes that? And in our view, the answer to that question is a big reserve currency devaluation. And we think that's exactly what we're seeing symptoms of today in gold markets.
Partly is the Fed, the attack on the Fed, part of it?
It's certainly part of it. We don't think that there's much evidence that this concern is widespread. But beyond just the attacks on the Fed, we've just resumed an interest rate cutting cycle in a macro context that perhaps arguably is in which it's hard to argue for rate cuts. More importantly, we think the last several decades have been characterized by the rest of the world recycling their U.S. dollar, their U.S. dollars back into U.S. assets, and that's really the key to what's changing here. The U.S. dollar is losing at least part of its store of value function, and in turn, gold prices are capturing a part of what the U.S. dollar has lost.
Central banks, of course, a crucial driver. I guess that's part of the story. They have been anyway, acquiring more gold to balance against their exposure to the U.S. currency.
Yeah, central banks are certainly part of the story. Over the last few years, they have been buying massive clips of gold. The interesting piece, I would say, in the latest rally in gold is that this seems to be the first in a long time that seems overwhelmingly tied to Western interests. And that's a key difference, right? Because we think when the East buys gold, that gold essentially is semi-permanently drained. When the West buys gold, and this would include investors, retail participants, and so on, every ounce of gold that is purchased by the West is eventually resold into the market. So that's what characterizes the difference in the latest rally in gold and why we're perhaps a little bit more cautious than prior rallies.
Give us that again, why you're a little more cautious, Daniel. Give us your reasoning there.
Well, on the first hand, we think that macro funds for the longest time have been sitting on the sidelines, at least since the fallout of Liberation Day. What seems to be happening now is we're starting to see signs of FOMO from the macro fund community. Their participation following gold's breakout has really been the underlying driver of why gold prices are rallying. And the reason that that's concerning is because this is an investment position, which means that if the narrative turns around, their positions will too. Whereas gold purchases in the East tend to just never see the light of day again. And so rather than what we saw earlier this year as a semi-permanent one-off translation higher in the gold price, what we might be seeing now is macro fund FOMO supporting gold prices higher, which leaves them vulnerable to subsequent selling activity.
Is this a sign we should be worried about global stability when we see gold going up like this?
Global stability in and of itself hasn't changed. But what we should be worried about is the sustainability of the current system. Really what I mean by that is, if you look at the last 20 years, global sovereign debt went from roughly $50 trillion to $155 trillion. The U.S. accounted for the overwhelming majority of that. And I think that in the current administration, the rest of the world is starting to rethink whether their U.S. dollar exposure should remain as high as it is today.
Any thoughts on silver? We know it's an industrial metal, yada, yada, but a much smaller market than gold. Is it likely to outpace its big brother, do you think?
Yeah, we think this is the end game of what we envisioned for silver. If you recall, Andy, we've spoken about this quite a few times. This is what we saw as the silver squeeze you can buy into, which is really premised by a drain in London vaults, free-floating inventories of silver. We think that drain has now reached a level that is critically low, meaning that at the average pace of ETF inflows over the course of historical cutting cycles, there are probably less than 4 months remaining until the LBMA's entire free-floating inventory stockpile is depleted. That means that the risk of gaps in prices is more elevated, liquidity is critically constrained, and every further drain from current levels should be supportive for prices and at a convex fashion, meaning faster and faster fashion.
Daniel, thank you very much indeed. Daniel Ghali, Director of Commodity Strategy at TD Securities.